Welcome to CBS online lecture. We are studying chapter 9 titled as Terms Used in Business Accounting. Our today's topic is Purpose of Accounting. At number 1 we have Preparing Financial Position. Financial positions basically reflects the financial condition of a business at a specific date or time of the year. The financial position contains all the financial details about the business. For example, how much money has been invested in the business, how and where these funds were utilized, how much of profits or losses the business made in a year, etc. The second purpose is to measure the performance of the business. Accounting helps to determine how well a business is performing. So what accounting does is it collects, analyzes, summarizes lots and lots of data and brings out useful information which helps to measure the performance of the business. Later, this information again allows organizations to compare themselves against their own past performances and also against their competitors. On number 3, we have mistakes and fraud detection. The resources of a business are vulnerable to losses, which might arise from theft, fraud, mistakes, mismanagements, and so on. So basically, the business cannot entirely eliminate these risks, but accounting ensures that such risks are reduced down to an acceptable level so that the business doesn't have to bear losses. Number 4, planning and controlling. An organization needs to plan how they will allocate their limited resources to fulfill all the future needs, right? So you know that resources are limited and they must be put into correct use for maximum output. And accounting helps organizations with these financial plannings. Also, placing sufficient internal controls within an organization for the safeguard of these limited resources is also another purpose of accounting system. So it helps both in planning and controlling organizations' resources. Up next we have aids in decision making. So another main purpose of accounting is to provide accurate information to the users of accounting information. So they can make a range of business decisions and also develop policies to make the organizational process more efficient. Some examples of management decisions that are based on accounting information might include, say, the price that should be charged for the products or services to achieve maximum profit, or whether a business needs to acquire financing or not, or whether a business should offer credit to a certain customer, etc. And the last point is comply with law. Accounting is a legal requirement for most businesses, meaning you are legally bound to do the accounting calculations and draw up financial statements. You'll also have to report these financial results to the owners, managers, or tax authorities for tax purposes. So these are the 6 main purposes of accounting. Transactions. So you must have heard me mentioning the word transaction a couple of times, right? Now we'll see what a transaction actually means. So as the slide reads, transaction is an event or business activity which involves exchange of money and goods between parties. So whenever a good is purchased, it involves receiving the product and making immediate payment or creating an obligation to pay to the seller at a future date. These events and activities are known as transactions. Here, another very important point states that these events can be measured in terms of money, and it changes the financial position of the business. So as we already know that accounting deals with financial data only. So these events and transactions can also be measured in monetary terms, and in turn it affects the financial position of the business. So any event that cannot be expressed in terms of money is not a transaction. Now transaction can be of 2 types, cash and credit. Cash transactions. When the parties settle transactions immediately by making payment in cash or by check. So you purchase something and you make immediate cash payment, or immediately You pay the money by a check. That is your cash transaction. On the other hand, we have credit transaction, where the payment is settled at a future date as per agreement between the parties. So you buy now and you promise to pay the amount later to the seller. So you buy now, you pay later. That is your credit transaction. That's it for today's class. Thank you.